Hello, everyone. Thank you for joining me today. My name is Kathleen Levito, and I'll be your host for today's webinar titled Funding the Future, Developing a Savings Strategy for Your Children's Education. Joining me today is Tony Oliver, Relationship Manager with AAFMAA Wealth Management and Trust. This monthly webinar series is brought to you by AAFMAA Wealth Management and Trust. Our vision is to ensure the financial security and independence of members of the Armed Forces community, active, retired, honorably discharged service members, and their families. We accomplish this by being the premier provider of financial planning, investment management, and trust services for all branches of the military. We are AAFMAA's trust company. AAFMAA stands for American Armed Forces Mutual Aid Association. AAFMAA, created in 1879, is the longest-standing, not-for-profit association exclusively serving the military. We empower military families with affordable financial solutions. AAFMAA focuses exclusively on the needs of military families and provides innovative, personalized, and lifestyle-appropriate financial services. A key point that sets AAFMAA Wealth Management and Trust apart from other companies is that we are a fiduciary. What that means is we have a legal obligation to act in your best interest and for your benefit. One important disclaimer before we begin this month's webinar. The information presented herein was compiled from sources believed to be reliable. This presentation is for educational purposes and is furnished without responsibility for completeness or accuracy. It's general information and is not specific investment, legal, or tax advice for any individual. Do not rely on this presentation alone to guide your financial planning decisions. Since each individual situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources available to them. I will now go ahead and turn it over to Tony to begin the presentation.
Thanks, Kathleen. I just wanted to mention, here's our agenda first, where we're going to talk about strategies for your child's education. We're going to cover expenses to consider for education, education and financial aid, tax advantage plans for education, additional tax credit plans, employer assistance, the impact of scholarships, and educate your students about how to manage money. And then one more note, and this may have been in one of our advertisements, but on average, tuition tends to increase about 8% a year. And 8% college inflation rate means that cost of college doubles every 9 years. For a baby born this year, this means that college costs will be more than 3 times the current rate when the child matriculates to college. Over the past few years, the cost of inflation for college has actually been higher than healthcare. Okay, next page, Kathleen. Expenses to consider for education funding: tuition, books, lodging, transportation, insurance, meals, entertainment, fraternities and sororities, computer, internet access, and much, much more. Education and financial aid. All students and parents should complete the free application for federal student aid, better known as FAFSA. This begins the financial aid process. Information from FAFSA is sent to the colleges of your student's choice. Information on the FAFSA is used to calculate the expected family contribution. The expected family contribution is a measure of how your family's financial strength and is calculated according to the formula established by law. Again, the expected family contribution, or EFC, it's a formula that was developed by Congress used to determine how much a family would contribute toward their child's education. The EFC gives you a dollar amount that qualifies for your federal financial aid. The EFC can vary by each school. If you're hoping to receive a substantial amount of need-based financial aid for college or graduate school, your expected family contribution will be one of the most important numbers you'll ever see. The EFC determines a student's eligibility and how much is awarded. Need-based financial aid is financial aid you receive because you couldn't afford college otherwise. Merit-based financial aid doesn't depend on your college, on your family's financial situation, but it's based on other factors like your academic, athletic, artistic, or service achievements. Financial aid programs. Federal Pell Grant, it's free money, it's not a loan. Stafford loans, subsidized or unsubsidized, we'll talk about that in a second. Parent loans for undergraduate students, Grad Plus loan for grad students, and Federal Perkins loan program. The Federal Pell Grant is not a loan, it's about $6,000. It's based on the student's financial need. A Stafford loan is primarily a type of financial aid provided by the U.S. Department of Education. Again, the Stafford loan, it can be subsidized. It can be a subsidized loan, which means no interest is charged until graduation. Although, if you leave school or enroll less than half time, then you will start paying interest. An unsubsidized loan charges the interest when the loan is dispersed. A plus loan, parents borrow based on their credit, not needs-based. Plus loans are unsubsidized. Next, a grad loan. A Grad Plus loan, you need to be enrolled at least half time. Federal Perkins loan program is for students with exceptionally low EFC amounts. A lot of the financial aid programs are related to the adjusted gross income phase outs. And what I mean by phase out, a phase out in the financial world refers to the gradual reduction of a tax credit that a taxpayer is eligible for their income as their income approaches the limit to qualify for that credit. In layman's terms, credits may not be available if your income's too high. Campus-based financial aid. The Federal Supplemental Education Opportunity Grant. It's awarded to students with very low expected family contribution, and it's also a need-based, or also a federal work study, or on or off-campus employment to help pay education expenses. These federal programs are more like to fall under the umbrella of campus-based aid, which means that the federal aid office at a particular school is responsible for administering the program. Each participating college only gets so much money for these programs. So once it's all awarded, the school can't hand out any more. This is why it helps to get your federal student aid application in as early as possible. You should pay attention to your college application deadlines for these programs because they might be different from the deadline for their federal application. You may also hear a term called need-based, I mentioned before. A need-based scholarship are exactly what they sound like. They award students who have financial need. Students qualify for need-based scholarships based on their family's income. Still, many need-based scholarships take into account an applicant's grades and test scores. Tax advantage plans for savings, education savings. We're going to talk about qualified state tuition, prepaid tuition, savings plans, ABLE accounts, Coverdell education savings accounts, Series EE savings bonds, Uniform Gift to Minors Act. Qualified state tuition and prepaid plans. Basically purchasing college credits today for a specific state. Use this credit when your child goes to college. This is considered an asset of the parent for financial aid purposes. The advantage, you're locking in today's cost of that college, how much it costs today. Disadvantage, only earn a return equal to tuition inflation. Student may receive a scholarship. If the student receives a college scholarship, you don't need the prepaid tuition. If you cash out, you only receive your principal back without interest. If for any reason your student does not attend the selected state, again, you'll have to pull up, cash it out. The big plus here is that you're paying for your son or daughter's college in today's dollars. This is a program that you want to feel very confident that your son or daughter will attend the college or university in your state. And also too, it pays only for tuition and mandatory fees. Beware, it does not pay for room or board or books. Savings plan or 529 savings plans. Contribute to a savings plan that invests in a diversified portfolio of stocks and bonds based on your child's age. Any appreciation is tax-free if used for qualified education expenses. You can only contribute up to $15,000 per year. There is something called a 5-year election. You can contribute up to $75,000 and treat the contribution as if it were spread over a 5-year period. A couple that elects gift splitting can contribute up to $115,000 in 1 year. If they want to do it again, they have to wait 5 more years. Grandparents can contribute to a 529 plan owned by the child's parent, and it's considered as a parent's asset for financial aid. Advantages of a 529 plan. Here's the best one, I think. It's possibly that it's state income tax deductible for contributions. There's no phase out for who can participate. The owner controls the account, the parent. You can change the beneficiary anytime. If your son's thinking about going to college and changes his mind and doesn't go, then you can change the beneficiary to your daughter or a grandson or granddaughter. The contributor can remove assets from gross estate. Beginning in 2018, up to $10,000 of annual distributions may be taken from a 529 plan to pay for tuition for elementary or secondary public, private, or religious schools. Disadvantages. There's a 10% penalty and it included in your gross income if you do not use for qualified education expenses. There is an exception for the 10% penalty, which includes death, disability, or scholarship for beneficiary. There's a few special exceptions to the 10% penalty rule when the beneficiary becomes incapacitated, attends a U.S. military academy, or gets a scholarship. In case of a scholarship, a non-qualified withdrawal up to the amount of the tax-free scholarship can be taken out tax-free, but you'll have to pay income on the earnings. Note again, a 529 is considered assets for financial purposes. That said, the 529 plan by far is my favorite college savings plan. Most states offer state tax deduction for contributions. Grandparents can even make tax deductible contributions if they own the 529 plan. This does not affect the FAFSA until the money comes out of the grandparent's 529 plan, and then it counts as a student's income for next year's FAFSA. Usually best to use the grandparent's 529 plan later than sooner. Grandparents can also contribute to the child's parent's 529 plan, but don't get the tax deduction. About 15 to 20% of 529 plans in our country are owned by grandparents. Where is the best place to find a 529 plan? You can usually Google Morningstar 529 plan rating. Again, Morningstar 529 plan ratings to see their ranking details. Also, too, usually lifestyle funds for 529 plans, they usually rebalance. For example, a 1-year-old might have 100% in equities and it automatically adjusts based on age. Perhaps by the time they're 16, it might be 90% stocks and 10% money market. $529 ABLE. This is for the disabled. ABLE stands for Achieving a Better Life Experience. It's similar to a 529 plan. The beneficiary must be entitled to Social Security disability, and also it was created or it follows the Tax Cut and Jobs Act, allows for a 529 plan to roll over to a 529 ABLE plan. Only one ABLE account per beneficiary. The maximum contribution is $15,000. Be aware, the account balance, if it goes over $100,000, it will suspend Social Security and the disability income. Qualified expenses are a little bit different. Again, this is for disabled people. And this is a good choice that might help balance it with a special needs trust. But the extra expenses are education, housing, transportation, assistive technology, personal support services, and legal fees. The ABLE account can allow eligible individuals to accumulate more than $2,000 in assets without losing federal funded means-tested benefits. This includes supplemental security income and Medicaid. Funds in an ABLE account are not taken into consideration when determining eligibility for these types of programs. You might, if you have a special needs trust, you might want to consult with an attorney on this. Coverdell Savings Account. Coverdell Education Savings Account. Contributions are limited to $2,000 per year per beneficiary. Contributions grown tax deferred unless used for qualified education expenses, in which case are tax free. It includes private elementary and secondary education. The owner may change the beneficiary. You must use the funds by 30 years old or they have to be taken out. There is a 10% penalty and included in gross income if not used for qualified education expenses. It's considered an asset of the parent for financial aid purposes. You cannot make contributions beyond the beneficiary's 18th birthday. Here's a page that kind of describes the differences between a 529 plan and a Coverdell. At the top, basically everything's pretty similar. Contributions, they're not deductible for either. Reinvested earnings are they taxable? No, they're not. Qualified withdrawals taxable? No. Non-qualified withdrawals taxable? Yes, with a 10% penalty. Here's the big difference. Dollar limit on contribution. Very high for the 529 plan. You might remember I mentioned earlier, where a couple could contribute as much as $150,000 in 1 year, whereas at the Coverdell, it's only $2,000 a year. Also, age limit contributions. A junior can be 50 years old and still have a 529 plan, and you still can contribute. You cannot contribute to a Coverdell once your child reaches 18 years old. Age limit on ownership of the account, again, not age limit on the account for the Coverdell is 30 years old. In other words, you have to cash it out at 30 years old. Qualified education, both of these work for a K through 12 or post-secondary. Included in the account's owner's estate, no for either one. Adjusted gross phase out, 529 plan, no. Coverdell, yes. In other words, a 529 plan, you can earn as much money as possible and still make a contribution. In a Coverdell, you cannot. Roth IRA, education benefit. There's a 10% penalty is waived on all non-qualified distributions used for education expenses. You can always withdraw contributions and conversions without tax consequences, but it may impact attainment of your retirement goal. Withdrawal of earnings is generally taxable. If you're in a bind, and this is why I mentioned this for college education, a Roth IRA might actually work. If you have held the Roth IRA for 5 years and over 59 and a half, you can pull out your Roth IRA tax-free for college. Caution, caution, caution. Just keep in mind your retirement. You can always finance a college education, but you cannot finance your retirement. Series EE savings bonds. You may convert, they may be able to convert into a 529 plan or a Coverdell education savings account. You must cash in the EE bond and invest proceeds into the 529 plan or Coverdell. There's no federal income tax on the interest if used for qualified education expenses. The bond must be redeemed in the same year as education expenses are incurred. Bonds are not purchased in the child's name, and the buyer must be 24 years or older when purchased. EE savings bonds are available only through Treasury Direct online. They are non-marketable, non-transferable, redeemable after 1 year with a 3-month interest penalty if redeemed in less than 5 years. EE bonds are very rigid and current interest rates are low. UGMA or UTMA. UGMA, Uniform Gift to Minors Act, and/or UTMA, Uniform Transfer to Minors Act. These were created in 1956, so they've been around for a while. These assets are considered an asset of the child when determining financial aid, which is what you do not want to have typically. Taxation of the unearned income, like interest, dividends, capital gains, may be subject to a kiddie tax, high tax. If the child is 19 or older, then the unearned income is taxed at the child's rate. The exception, a full-time student age 23 or less is subject to the kiddie tax rules. The primary risk is that the child can use the assets for something other than education. And UTMA, again, Uniform Transfer to Minor Act, can include real estate as an investment, plus stocks, mutual funds, and bonds. Uniform Gifts to Minor Act only includes stocks, mutual funds, and bonds, but does not include real estate. Again, once the child turns, if they own UGMA or UTMA, once the child turns age of majority, 18 in most states, it becomes their money, and they can do anything they want to it, and yes, that includes beer. Additional tax advantages for education funding. The deductibility of student loans. Interest on the student loans is deductible above the line before adjusted gross income. Amount is limited to $2,500 a year. Loans must be used for tuition, room, board, supplies, and other necessary expenses. And again, there is adjusted gross income phase outs. Here's another advantage, additional tax advantage for education funding, lifetime learning credit. Tax credits available for tuition fees related to an undergrad or graduate or professional programs. Tax credit amount is 20% up to $10,000 in qualified expenses. The maximum credit per family is $2,000 per year. Example, you have a son that attends a school and incurs a $4,000 expense, and the father attends a school and incurs $8,000 expense. The total tax credit for the family is $2,000. The lifetime learning credit is also available for grad students and professional programs. Here's another additional tax advantage for education. It's called American Opportunity Tax Credit. It applies to tuition and fees for the first 4 years only of post-secondary, so it's not for graduate school. Tax credit consists of 100% of the first $2,000 of qualified expenses, 25% of the second $2,000 of qualified expenses. Maximum credit per student is $2,500. Per student deduction is based on the number of dependent students of the family's tax return. So in other words, if the student's not dependent, can't use it based on that family. Example, a son who's a freshman incurs $4,000 expenses, and a daughter who's a sophomore incurs $5,000 of expenses. The total credit for the family is $5,000 or $2,500 per student. Important considerations. An individual may claim the American Opportunity or Lifetime Learning Credit in the same year as the distribution from a 529 plan or other qualified tuition plan, just not for the same expense. An individual may not claim both the American Opportunity or Lifetime Learning Credit for the same child in the same year. Employer Education Assistance or Fringe benefit. An employer may pay for or reimburse an employee for education expenses. Any benefit is a reimbursement, or any benefit or reimbursement is not included in income up to $5,250 per year and is deductible to the employer. The impact of scholarships. Scholarships help to lessen the impact of rising tuition costs. Scholarships help students have more time to focus on their studies. Scholarships decrease the number and amount of loans students need to take to complete higher education. Scholarships can fill the gap. Scholarships can teach philanthropy. I have trouble saying that word, philanthropy. Cultivate relationships with professors as they might be the decision makers for scholarships. Be very, very, very proactive and invest time searching for scholarships. Example, there's many, many websites out there. One's called fastweb.com. And to kind of give you an idea of how many scholarships out there, let's take a look at a few of them. Here's one called David Letterman Telecommunications Scholarships, $10,000. Clowns of America, International Scholarship. Doodle Google Scholarship, $30,000. National Potato Council Scholarship, $10,000. Sophie Major Memorial Duck Calling Contest, $2,000. And I'm not making these up. These are very real. Most scholarships go unused. There are many books out there that can help you apply for scholarships. Talk to your English teacher in high school. Most scholarships require an essay. You will need to write an essay to a specific audience and what's important to them regarding their specialty or degree you want to pursue. Apply, apply, and keep applying. Once you get on campus, build a relationship with a professor. They also may be knowledgeable and a source of scholarships. Sit down with your student and talk about the student loan talk, the credit card talk, and the budget talk. That sounds like fun to talk with your teenager about that, right? The student loan talk. Today, it's very common for kids to take out student loans because parents simply cannot afford to fully fund the cost of college education. If your children are borrowing, be sure to talk to them about the implications of this decision. While student loan debt is generally considerable good debt, it can still be hard for the young people to pay back, and it's your kids, and your kids need to know this. It's essential that you explain to your children the possible long-term consequences of borrowing, including the fact that they're likely committing to a decade or more of payments. Their loans may mean they need to delay milestones such as buying a home. Make sure your kids know to compare rates on student loans so they can get the most affordable funding possible. You should talk to your kids about the options they have to borrow less, such as working while in school or searching for scholarships. And stress how important it is not to borrow for anything unnecessary, such as big nights out or vacation. The credit card talk. A consumer protection law called CARD Act has made it harder for college kids to get a credit card, but it is still possible for young people to get a student cards on their own. Many parents also decide to send their kids off to college with a credit card or will co-sign for the card with their children to help them start and build credit. While credit cards are important and helpful tools, your children, and they can assist towards developing a positive credit score. Credit card debt can be extremely dangerous. College kids who charge too much will likely struggle to repay, and they will owe how much they owe and incur high interest costs. This could lead to graduating with lots of high interest debt and have to be paid back. If your kids use credit cards irresponsible and don't pay the bills off on time, this could cause them to leave college with a damaged credit score. Future financial transactions such as buying a home or getting an auto loan would then be impossible or much more expensive. It's imperative that you talk to your kids about the risk of credit and its importance of using responsibility. Stress that while they may want to use a credit card, they should only use it to make small purchases and pay the credit card off each month. Number 3, the budget talk. Whether you're supporting your kids through college or they're getting funds from student loans, it's important your college-age child know how to make his or her money last. This is especially important if your child gets a lump sum payment from student loan funds in its beginning of the year. Have a conversation with kids about how they use the budget, their money, and make sure they aren't overspending so they have the funds they need for the essentials. If your child is going to be living off-campus on an off-campus apartment, make sure they think about necessities they may not have had to pay for, such as utilities. I'll talk now about the bursar's office. The bursar's office is the college financial office. When you pay for your tuition, you send your money to the bursar. Your student will probably protest, but make them visit the bursar's office. It will give them a place that they can see and touch and make it feel real. And the reason I say that, here's a true story. I have sent 4 daughters to college. At one time, I needed to send in money to the bursar's office, and I did not have the complete information. So I called the bursar's office to inquire what was needed for my daughter. The lady I was speaking with interrupted me and told me to tell my daughter that she was now an adult and tell her to march right down to the office to meet with her. I will help instruct her on exactly what to do. My daughter did in fact go to the bursar's office and meet with the lady I spoke with. It was never a mystery after that, and it was smooth sailing after my daughter visited the bursar's office. Probably the best piece of advice I might add to start saving for college is very, very early in your child's life. The less you're prepared when your student approaches college, the more stress it can create for everyone. Lastly, I hope this was helpful to you. AAFMAA Wealth Management Trust is a fiduciary. We don't sell 529 plans, but we'd be happy to talk with you about if you have any questions. Just give us a call or shoot us an email. Thank you so much for your time.
Thank you so much, Tony. That was incredibly informative. So if you happen to submit a question during the webinar, or if you think of a question later, feel free to reach out to Tony directly through the information on this slide. We have a phone number you can use. We have Tony's email address. And then also you can always visit us at afmaa.com/wealth for more general information. If you did submit a question during the presentation, be on the lookout for a response from a wealth management and trust relationship manager in the next few days. And if you think of another question later, again, please reach out through the information on the slide. We'll go ahead and break here for now, but please don't hesitate to reach out to us for assistance whenever you need it. We do this every day for our military community, and it is our pleasure. This weekend, you'll receive a follow-up email with instructions on how to access the recording of this presentation. And you can always register for future webinars and review past webinars at afmaa.com/webinars. Speaking of future webinars, be sure to join us in a couple of weeks when our team members at AAFMAA Mortgage Services present. If you found this information useful, we encourage you to please share it with your friends and family. Our membership grows stronger every year because you introduce those in your military community to AAFMAA. Thank you again for listening and for joining us today. We look forward to our next opportunity to assist you.